Alrighty, hello and welcome to the Upside with Eli. Today we're here with Brandon Murphy, CPA extraordinaire. Brandon, welcome to the show.
Thanks for having me.
Of course.
It's exciting to be here for the first time.
Yeah, today's episode is sponsored by coffee. We had a client event last night. We were out pretty late, so we're excited to be here with our coffees in hand. Today we're going to talk all about being a CPA and kind of how you ended up where you are, and some tips and tricks for business owners. So, why don't you start off by telling us a little bit about how you came to be a CPA?
Yeah, absolutely. So I grew up in northern Alberta originally, and fairly normal childhood and everything. But I always found I had a affinity towards money and finance. I remember early days where I would go to work. I started working at the golf course, and I would save up my money, put it in a savings account, and from there, I realized I'd have $1,000 sitting in my savings account, and it would make 2% interest. And I was like, cool, I can have money just sitting there earning interest over time. But I met a couple people in the Peace River area that were CPAs, and I was like, looks like a pretty good lifestyle. So I'm going to start off. I'm going to go to university and pursue that and see where it goes. And so I went to university in Calgary and started my CPA there, and that kind of fast forward to today. That brings us here.
Right on. And so, so what did you take in university? Then you took accounting in university.
Yeah, I focused on accounting in university.
And then for those who don't know kind of the path to becoming a CPA, like what does that actually look like? You do your undergrad and then what happens?
Yeah, so you start with doing your undergrad, generally in an accounting focus, and then from there you would find a firm or industry to go work at for your CPA, and you need about three years experience, so 2.5 to 3 years of accounting experience. And then you go through the CPA program as part of that process. So you do various modules that are generally tax focused or accounting focused, but there's also some finance focus in there as well. So anything from reviewing businesses, helping with strategy, discounted cash flow models, and come the end of that, that's when we get to that big exam. So CPA has that 3-day exam that most people study for a month to 2 months to prepare for that one. And so got through that, I think, in 2022.
Okay.
And ever since then, I've worked in public practice, worked with a lot of small businesses, entrepreneurs with a tax focus, also some stuff on the audit side as well.
Cool. And what made you finally decide when you joined us to kind of go into business for yourself and kind of run your own show?
Early on in my career and even back in high school, I've always had this idea that I wanted to start a business one day and work with other business owners. I kind of bounced around with the idea. I was like, well, maybe I want to pursue my CPA and become a partner at an accounting firm one day, or maybe I want to go to industry and work as like a CFO or a controller. But at the end of the day, I always liked the idea of ownership and building up my business and helping others build a business as well. And that's what really drove me to get here today, where I like working with business owners and kind of connecting the dots between business and personal finance so that people can grow and meet their goals tax efficiently.
Totally, and I think there's such a need for that, and we've seen that in just a few months that you've been here, like how much demand there is for exactly what you're offering, and you've kind of seen that firsthand. Obviously, you've got the experience from before, but you're seeing it even more so now. What do you think are kind of some of the most important, I guess, things that you kind of help business owners with now?
Yeah,
or what kind of mistakes are you seeing out there that people are just like, man, I have no idea how this works? Because the Tax Act, let's be honest, it's complicated. It's not simple for a business owner to manage these things.
Exactly. I have the Tax Act sitting at home. I think it's 3,500 pages, and I haven't read it cover to cover, and no one really should. You'll fall asleep.
and it doesn't read like a book either.
No, absolutely not. You got to bounce around. You got definitions, whatever. But yeah, there's a lot of things. There's a lot of mistakes that early business owners make, and I find generally people are really good at starting their business. They're really good in their trade, whatever that is. But when it comes to the accounting, the tax, the finance side, It causes anxiety sometimes, and that's really where I step in to help out people and starting up their business and making sure they take the next right steps. I think the biggest one for anyone that's starting a business from the get-go is, when do you incorporate? And I find people, they want to start a business and they jump in right away and they're like, I have to incorporate because it looks professional.
Yeah.
And that's not always the case. Like, if you want to start a business, usually you should start dipping your toes into it. Maybe you're working a full-time job right now and you're like, I want to do this, I want to try it out, so I'm going to do it on a part-time basis to start out with. And that's usually the recommended approach. And if you do that, you can just operate as a self-employed individual, and you don't have to go through all the paperwork, the legal fees, the accounting costs to setting up a business, and then you don't have those ongoing costs as well. And then try it out for a while, see if it's going well, and then take that next step to see if you should incorporate your business.
Mm-hmm. And the side that, a lot of people forget too is that most businesses don't make money, off the bat. And so I think there's a lot of value to people that have losses. If you're incorporated, you can't use those losses against that, your regular income and that you're earning, but you can obviously. And like you say, there's so many additional costs that come with having an actual corporation set up, where if you can avoid that and just focus on growing the business to begin with, again, you're just going to save a lot of money, right?
Yeah, exactly. And I think a lot of people don't realize that, is if you're just operating as a sole proprietorship, you might generate some losses in those first 2 years. You might have to buy equipment. You might have a lot of expenses. You might have some legal fees. You got marketing costs. That's all going to add up. And in those first couple of years, if you have other income, whether it's investment income or your full-time job employment income, you can claim those losses on your personal tax return. Once you incorporate, those losses are trapped in there.
Totally. And what do you see in your experience? Because I'll get questions about this all the time. Like, well, how many years can I run a loss for? And just use that, especially with farmers. We see that all the time. How many years can I just run a loss for before the CRA goes, hey, you can't. You got to show at least an attempt to earn a profit. What do you typically see?
Yeah, and I really, it depends, and
Sure.
We don't know where CRA is going to land on it. I would say anywhere from 3 to 5 years is a good rule of thumb, where someone might start to ask questions and say, okay, are you running a hobby here? And we see that all the time. Like you said, a farmer that's running a hobby farm, they're claiming a $10,000, $20,000 loss every year against all their other income. After a few years, that starts to become questionable. But yeah, there's generally no rule or no perfect answer to that one. But yeah, I think it's something everyone should be cognizant on, is if you are running losses year after year, ask the question of, if I'm pursuing this business and generally you're putting in a lot of time into it as well, does this make sense in the long run?
Okay, cool. And so, so when to incorporate? What are some of the other major questions, like the most common questions that you see from business owners?
Yeah, I mean, when to incorporate. Lots of times I see people set up their corporation and they get 6 months in or a year down the road. And then the next big question I see is, how do I pay myself now? Mm-hmm. Generally, they're used to being on a salary, or they've been operating their sole proprietorship in the past. So then the next question is, well, now I've got this corporation, it's generating income. How do I get that money out of the corporation tax efficiently?
Yeah, and what do you tell them?
It depends.
Always the answer. So what are some examples of situations where it makes sense to do X, Y, Z?
So generally in the first year, to keep things simple, I often recommend that they're going to have their corporation and that they basically just pull money out as they need. If you're running a business in the first year, generally we're not seeing large numbers. We're not seeing $1 million of revenue. If you are, it's a different conversation. But if you're running a business and it's 50,000 or 100,000 of revenue, and then you got your net income after that, generally it makes sense just pull the money out of the corporation and then pay it out as a dividend at the end of the year.
Just for simplicity, you don't have to deal with payroll. You don't have to deal with all these setting up these structures again in the first year.
Yeah, you've got so much going on, right? You're trying to build your brand. You're trying to understand the whole accounting piece. You're trying to find customers, and the rest of your time you're actually doing the work that is the business. Mm-hmm. So it makes sense, just pull the cash out, reconcile it at the end of the year through a dividend. But then after that, it's really good to sit down with an accountant, go through the numbers, and see if it makes sense whether to pay a salary or a dividend going forward.
And for people listening, I guess what are the main pros and cons of salary versus dividend? Because everyone always asks that. Should I pay myself a salary? Should I pay myself a dividend? Obviously, we know the nuances of it. How do you explain it simply to somebody, that the pros and cons of a salary versus dividends?
Yeah, absolutely. So when it comes down to it, I guess at a high level, when we talk about salary versus dividends, most people understand a salary because when they started the business, they were probably an employee somewhere before that. And drawing a salary is no different because your business is a separate entity compared to your personal life. So drawing a salary is basically you set yourself up on a payroll. You say, I want to pay myself X dollars a month, and you're going to pay yourself the payroll, and the corporation's going to take care of the payroll side. Dividends, on the other hand, is coming out of the after-tax earnings of the company. So that's basically the owner's position as a shareholder of the business. So that's where they can partake in the future growth and draw out of the after-tax earnings of the business. And then when you look at pros and cons between the two of them, so pulling out a salary is fully tax deductible to the corporation. So some people you might see where they have net income of $100,000 before any tax, before they paid themselves out of the business. If you take $100,000 of salary, your business now has zero income to pay tax on, essentially. And on the flip side, if you're pulling a dividend out of your corporation, that's with after-tax dollars. So any of that net income, you're going to pay tax on it first, and then it's going to be drawn out of there as a dividend. And if you're taking a salary out of your business, the biggest benefit is the RRSP contribution room. Usually when I run a calculation, that's what it comes down to, is you're drawing the money out of the business. You can take that RRSP deduction on your personal tax return. Then you get the tax deferred growth, and then you can pull it out in retirement where it'll be taxable. But generally the calculation comes down to, is your income higher now than what it's going to be in retirement? So RRSP contribution room, number one. Number two is you get the CPP contributions as well if you're drawing a salary. Now, everyone's got different opinions on
absolutely
whether you should take CPP or not, or contribute to CPP. And when I sit down with business owners, the biggest pain point I see is that CPP, you have to pay the employer portion and the employee portion. So rather than just being an employee where you see that 4.95% drawn off your paycheck every month, now as a business owner, you're looking at the holistic tax and you're at 9.9% tax on CPP. But there's a lot of studies out there. Generally, they show that people break even or make a decent return off their CPP. So personally, I don't look at it as a tax. I look at it as forced savings.
Totally, it's another piece of your retirement puzzle that can go together. But we both deal with people that are just adamant they don't want to pay into CPP, and that's totally fine. That's why there's dividends.
Yeah.
That you can pay. Obviously, you don't get the RSP room for certain types of lending. There may be advantages or disadvantages. But like you say, in your first year in business, when you don't have a lot of profits, you're trying to keep things simple. Right, that's another way. Okay, let's not pay into CPP maybe for a year or two. Just draw dividends. Just let's get our head above water, and then moving forward, you can kind of do some more planning.
Yeah, you can draw it out from there. And I guess for everyone listening, when you actually break down the calculation, and if we pull out the CPP, we call that forced savings for retirement, so it's not a tax.
Yeah,
we have this thing in Canada called integration. So a shareholder or an owner manager should be indifferent between taking out a salary or taking a dividend out of their business. It's supposed to be perfect integration, but it's not. So it really depends on what province you look at. We're sitting in Calgary, Alberta right now. So when you look at Alberta and you break down the calculation, you're actually saving a little bit of tax in Alberta taking the salary versus taking.
It's not a lot,
dividend.
but it is a little bit.
No, exactly. I think I just ran the calculation the other day for a client that wanted $100,000 out of their business, taking the salary, ignoring the CPA. They were saving $2,000 a year. by taking the salary relative to taking the
Sure.
dividends on a combined basis. So when you look at the tax that the company pays versus what they pay individually.
Yeah, makes sense. And so let's say we're, fast forward, we're 5 years down the road, the business is doing really, really well. I'm now in a really high marginal tax bracket, but my spouse is actually on the company. What are the rules in place now? What came out in kind of 2018, and what are the rules now in terms of, all right, how can I split income with my spouse, with my kids, all that kind of stuff? How do you explain that to business owners?
Yeah, glad you brought that up because see a lot of mistakes in that area as well. So in 2018, there was rules around TOSI, tax on split income, and it became a lot more stringent around things like adding a spouse as a shareholder to the business where they can then draw out dividends. And essentially, if you got husband drawing dividends, wife drawing dividends, you could lower the overall tax rate.
It was great.
Yeah, it's good times.
It was almost as good as having joint tax filing, but not quite as good. But it was a good time relative to now.
Yeah, it kept things simple. And so now you can't simply add a spouse onto a corporation as a shareholder and split the dividends. So I'll talk about dividends a little bit first as a shareholder. You can absolutely add a spouse onto the company and they can take dividends, but the caveat is they have to be actively working in the business. And I don't remember the specific rules, but I think it's 20 hours a week. They have to be actively working in the business, and then they can draw dividends out at the end of the year as a shareholder. So that's kind of the dividend piece as a shareholder. Another opportunity to split income with a spouse is by actually having them work in the company as an employee. And this can vary a lot. Like you can set the salary, and it can be maybe they work 10 hours a week. They're doing bookkeeping. Maybe they're doing some marketing stuff. Maybe they're running errands for the business. And as long as that salary is reasonable,
The key piece being reasonable.
reasonable for the market rates, like if they were to go get the same job at another business, what would they earn in that position?
And that's a good way to phrase it, because we always phrase it as, what would you reasonably pay somebody else who wasn't your spouse to do that same role? There's kind of that sniff test by CRA to say, all right, well, what would, what is reasonable relative to kind of what you're doing, right? If you're, just cleaning the office, that probably doesn't warrant $200,000 a year to pay your spouse to do that.
Yeah, exactly. If they're making a few social media posts a week and they're doing some bookkeeping on the side, then $150,000 probably doesn't make sense because that's not what the industry is going to pay. But nonetheless, yeah, great way to split income with a spouse or also with a child as well. I normally wouldn't recommend adding a child as a shareholder of the business, but paying them a salary.
Certainly not a voting shareholder.
No. Yeah, you got your 10-year-old in there. But yeah, you can also pay them a reasonable salary, and it depends on the province you're in. Like that kind of comes down to like child laws and employment laws. But I had a client a couple weeks back ask. They had I think it was a son that was 13 years old that was helping out with the business. I think it was a cleaning business, and they're curious because like her son would come with her and help clean and organize materials and refill bottles, everything like that. She's like, at what point can I start paying my son? So we went and looked, and it definitely varies by province. But what we determined is that next year, son is 14, she can start paying him a wage out of the business and in theory splitting income amongst the family. Again, as long as it's reasonable. If that son were to go out and get a cleaning job at 14, what hourly wage would he be paid?
Yeah, makes sense. And then getting back to TOSI, so TOSI rules primarily affect those under the age of 65. What happens after the age of 65?
Yeah, after 65, it's a celebration. It's open season. So this is where you can have a spouse on as a shareholder. After age 65, the income splitting rules really open up for a lot of people, both in terms of pension income, but also for business owners. So they have the opportunity to now split dividends between husband and wife that are on a company. And rather than having spouse A draw $200,000 in dividends, now you have spouse A and B each draw $100,000 in dividends. And because we have a progressive tax system, you're going to lower the overall tax rate between those two individuals.
Yep, makes sense. Cool. Other things that business owners want to know. So we've talked about when to incorporate, how to pay ourselves, kind of out of the corporation. What's a third one that people always ask you about?
Third one would be probably tax rates would be a big thing. So the reason people jump to incorporation, usually from the get-go, is they had their friends and family tell you way lower tax rates in your business.
Yeah, hear it all the time. Yeah, I want to incorporate so I can pay less tax.
Which is absolutely true, unless you need all that money out of your business. And that takes us back to when should you incorporate or not. If you don't need all the money out of your business and you want to grow your business, the tax rates are very favorable for corporations in Canada. In, I think, all provinces except for one, your first $500,000 of net income is taxed at the small business rate. And in Alberta, that small business rate is 11%. You're not going to see that on the personal tax side. So if you can leave money in your business, you draw out what you need for a salary, you leave the rest of the money in your business, you can use that money. It's taxed at 11%. You can use that money to grow the business, whether that's purchasing additional equipment, expanding your marketing plan, hiring more employees, and leaving that money in the business is generally more favorable. So that's the biggest question I always get asked is, I should incorporate because the tax rates are lower, right?
Totally. And a lot of people don't realize, too, is that investing money within your RRSPs is actually more tax efficient over the long run than keeping that money in a corporation. There's refundable dividend taxes and that when you're investing corporately, but we have enough data to show it's clearly more efficient to use an RRSP. And so if you have the RRSP room anyways, and you're going to be pulling the money out of your corporation to put into your RRSPs, unless your RRSPs are maxed, you're still better off waiting from a pure tax perspective, right? There might be other legal reasons that you want to be incorporated, but yeah, from a pure tax perspective, that's another reason why if you can use RRSPs first anyways, you're going to do that, and then again put off the incorporation.
Yeah, exactly. Like using up those RRSPs is great. And the magic number for people that are incorporated is whatever that RRSP max is. I think 187,000. You take your salary up to there, you max out your RRSPs, leave the rest in the corporation, and you can either invest that or you can use it to grow your business. And I find generally entrepreneurs, owner managers, they're always looking for ways to expand their business, expand their customer base.
Totally. And, if we project a few years out, obviously the small business rate, across the country is generally between, 11 and kind of 15%. And then you have the general rate. How do you explain to people the difference between the small business rate and the general rate?
Yeah, I mean, it comes down to one number, really, $500,000 of net income. So once your business is earning more than $500,000, any additional income above that is going to be taxed at the general rate. In Alberta, we're looking at 23% for that rate. And that's where you can also start to make more tax planning decisions around, should we take a salary that gets us below the general rate and back into the small business rate, because there might be tax savings there. But generally that's the magic number. So, and it's all a flat rate again. So once you get above that $500,000 threshold, 23% in Alberta, that's the general rate.
Yeah, makes sense. And which kind of ties back to, some of the other factors that, am I leaving the money in the corporation, going to grow it inside that, defer paying the taxes on it? What happens when people have too much money inside of, say, their business or their holding company or any kind of, connected company, is they do start to lose some of that small business rate, right? So they lose that small business deduction. So if you're earning, over $150,000 passively within your corporation, what starts to happen?
If you are earning more than $150,000 in passive income, so this is for everyone listening, passive income in your business is going to be, you had excess cash and now you're investing that. Whether it's just sitting in a savings account or you have it kind of invested in some sort of fund, it's going to generate income, whether it's capital gains, interest income, or dividends. And when you combine all that passive income, it's going to start to grind down your small business limit of $500,000. So it starts at $50,000. Once you hit $150,000 in passive income in the corp, you lose your entire small business limit. And for someone that is actively running the business, this can be a problem because they're losing their 11% tax rate in the business compared to someone that has a holding company or they're retired and the active operations of the business have subsided. Then we're not as worried about that small business rate because all of the income is being taxed at the passive rate anyways.
For sure. And that's, kind of going back to that's why it makes sense to max out RSPs. You look at things like IPPs. We want to keep, it's going to be so situationally dependent, right, on kind of how we're managing that. But a lot of times people get caught off guard because $150,000 passively inside your corporation is not a large number, right? All it takes is one decent year in the markets. And all of a sudden you're kind of over that number, and it's hard to kind of plan for because markets ebb and flow and they're different year to year. But kind of managing that's also going to say, okay, how much am I paying myself in salary? How much am I drawing in dividends? How much am I contributing to RSPs? How much am I potentially putting into an IPP? Like it can get pretty nuanced, right?
Yeah, absolutely. So it's definitely something to watch as you're growing the business, and if the mindset is to grow the business and expand and kind of step away where you're building a team, then it always makes more sense to kind of grow the business that way and invest in expenses or capital equipment where you're still going to get everything at the small business rate. And the next step is watching that passive income so you don't grind down your small business limit.
Yeah, absolutely. And so we're kind of at the end here. In terms of if people have more questions and they want to know more, where should people go?
Murph on Money on TikTok and Instagram. You can reach out to me here at Up Financial as well, Brandon at Up Financial, and we'll jump on the phone and see how I can best help you out with your business venture.
Yeah, and you have a webinar coming up?
I do have a webinar. Yes, I didn't get a chance to plug that in yet. So everything we talked about here today. So whether you're looking to incorporate your business, you're wondering when's the right time, maybe you just incorporated and you want to know how to pay yourself out of your business and how to grow it tax efficiently. All of those things right down to what are some commonly missed tax deductions for your business. Webinars coming up on January 17th. Live free event. You can sign up today. It's open, and feel free to submit questions beforehand as well, because I want to really tailor the session to the audience and see what business owners are looking to have answered. And
yeah, absolutely. And that's across Canada, correct?
Yeah, it'll be open to everyone across Canada.
Yeah, no, that's great. We'll put a link in the bio for you, and looking forward to that one. But yeah, thanks so much for joining. I'm sure we'll have you back again soon. If anyone has any questions, feel free to put them, ask away, and we'll make sure Brandon answers them for you.
Awesome.
Right
on. Thanks, Eli.
Thanks for joining me.